got Brookfield's Bank of America Tower in Los Angeles, downtown Los Angeles, sees a 69% decline in appraised value. Now, when I hear appraised value, I'm like, yeah, but is that realistic? I think in this case it is. Almost a 70% loss of value. Let's get into it. I'll tell you why. Here we go. So when I see these stories, I usually think, well, yeah, but the only way you know what the real value in something like this is if you put it on the market. What does that look like? Oh, we don't know. It's not on the market. But what we do know is, let's get into the story. The value of a downtown Los Angeles tower owned by an affiliate of Brookfield Asset Management Ltd. Limited was slashed 69%, the latest sign of troubles for offices in the United States central business districts. I am down here in Oklahoma City, and I was running around with my dad and my son. They're both still appraising. I am not currently, but we were in downtown Oklahoma City on a Tuesday at like 2:00 in the afternoon, and there was nobody there. And it's a pretty specific downtown core basis. And it just felt like a ghost town. And it's because so many people are still working from home. I know you got big corporations that are sending their people back. You got the federal government. You're going to have to go back in the office. You got Amazon in Seattle saying January 2nd, Happy New Year, 5 days a week. You guys are back in the office. So, you've got this switch up happening, but it's not having much of an impact in some of these downtown cores. And Oklahoma City felt like one of those, and a bunch of vacancies at street level, because those are often businesses that support all the people in the rest of the high rises, right? Downtown Oklahoma City's just got a handful of big skyscrapers, but it's the same dynamic. If you don't have enough people to populate your buildings, then you're not going to have the businesses that support them, and it starts to look like ghost town. The Bank of America Plaza, a 55 floor tower. Not flower, 55 floor flower, no, that hosts the home office of Asset Manager Capital Group, was appraised at $188.9 million. It's appraised at that. And so when I'm thinking that, I'm like, yeah, what do you got for comps? Well, we'll see. Down from $605 million 10 years ago. And I would say, well, I call BS on that. Where are those numbers coming up? Because I always call BS, because I'm an appraiser. That's my background. And now I'm a managing broker. Still doing the same thing, right? But trying to figure out value. So that is a loss of over 67%. Massive in 10 years. That's according to a filing last week for the property's mortgage. So you go out and get an appraisal. Who ordered the appraisal? Probably the servicing company, maybe the loan originator, but this property is already in, receivership, right? It's already got a special servicer because they've defaulted on the mortgage. So your original mortgage holder says, no, we're not going to deal with this. These guys ain't paying. Therefore, we're getting a special servicer. U.S. office values have plunged and vacancies soared since the double shock of the post-pandemic vacancy increases and soaring borrowing costs. So you've got the work from home phenomena going on top of all of these shorter term commercial loans coming due. And when they were originated, you had rates that were way lower. Now you're up over 7%. I don't know what commercial rates are, but relative to, we were at 2 3/4 in residential, and then that bumped up. It's over 7% now. So you more than double 2.5 times your interest rate in an environment where your income has shifted downward dramatically. That's how you get damn near a 70% reduction in value. Office values in U.S. central businesses districts fell almost 53%. They're down almost half. This is from March of 2022, and that's through September of 2024. 53% drop, and they'd already dropped a bunch before that. So that's where you get that additional probably 17% run, right? Getting it up close to 70% drop in values. Office availability rate in downtown Los Angeles, which is among the hardest hit areas, was about 38% in the third quarter, 38% in quarter 3 of 2024. So where can we compare that to? Well, we can compare that to some of the numbers coming out of San Francisco, downtown San Francisco. Yeah, probably in the mid-40s there, realistically. Downtown Seattle, 33%, somewhere in that range. But you got a lot of downtown cores that are approaching that 40% vacancy range. I think that's where the numbers tap out, somewhere in that range, because you will see interest rates go down here at some point. You will see these properties turn over. And when they do, you're going to have new owners. They're going to get, new tenants in because their debt is going to be far less. You're going to see this stuff start to shift. And so I think, around that 40%, some are going to be a little bit less, some are going to be more. That's where we tap out at. The delinquency rate on U.S. office commercial mortgage-backed securities, CMBS, that jumped to 9.3% in October. All right, so delinquency rate, that is, you got 10% of the commercial mortgages out there are now in delinquent. They're in some kind of special servicing category, right? 1 out of 10. That is massive. And that's up from 5.7 a year earlier. So almost a doubling of the delinquency rate. That's huge, huge. And that is reflecting what's going on with interest rates higher and values absolutely plummeting. It's that double whammy. The BofA Plaza, built in 1974, the building we're talking about, and renovated in 2009, has a $400 million in commercial mortgage-backed security debt. 400 large, right? And that matured on September 1st without being paid off or refinanced. Ooh, it was 79% leased as of July. All right, so let's look at that. $400 million in debt currently, and it's got a value of 100 and what did we say? 188.9. Yeah, I'd say that debt is going bye-bye one way or the other. Lender's going to foreclose. You do a commercial deed in lieu of foreclosure, whatever that looks like. Bring in equity partners, probably not, because nobody wants anything of this, magnitude of debt. They're going to let it go back. Bank's going to take it over and then, put it on the market and see what they get, bring investors, whatever. But it's going to be way, way less with the market value now of, I'll call it 190 and 400 in debt already. Yeah. And they haven't paid it off or refinanced it, meaning nothing is going on, even though that time came and went where they needed to come up with a new loan. Because that debt, that 400 million had already been matured, and here's the kicker. If there's a funny comment in a financial article, this is it, right? There's always one zinger, but they don't really intend it to be a zinger because they're actually serious about it, and it is. Here we go. We remain in discussions about a path forward for the loan and the building. We remain in discussions. We're talking about it. We're not doing anything. We're talking about it. And that is because there isn't a path forward for the loan, probably default, probably foreclosure, some kind of deed in lieu, right? And for the loan and the building, because the building's in play. But you know what? 79% leased. That's pretty good. That's pretty good. So what that tells me is that they've got tenants in there that aren't paying a ton. And that's why the building is, valued currently as little as it is, on top of comparable sales out there, which are reflecting the cap rate for this type of building. And that's just, you take the simplified cap rate is you take the gross income by this rate, and that gives you a value. And the way they figure out that rate is they take the sales price of the building, divide it by the income, and that's your cap rate. So we remain in discussions about a path forward for the loan and building because that's all they can do. Talk about it. Hey, let's talk about it. Let's talk about this some more. Well, yeah, it's overdue. What are you going to do? Talk about it because nobody wants to refinance us out of this loan. The loan has been managed since July by special servicer CW Capital, which declined to comment. Hey, you want to talk about this loan you took over? Not really. No, I don't think so. Bank of America Plaza is one of 7 properties in the Brookfield downtown Los Angeles portfolio, all but one of which have defaulted on a total of $2.2 billion in debt. 2.2. That's large, right? Portfolio included the gas company tower, once valued at more than $630 million. Okay, so we had a value of 630. Here's our comp. This is our comparable sale as such, right? 630 million, which the county of Los Angeles has agreed to purchase for an amount not to exceed $200 million. It's going to have a sales price Under 200, maybe it's 175, maybe it's 185, maybe it's 190, but under 200. So 200, original value is 630. That is almost identical ratio to what we're dealing with on this other the property that we've only got the appraised value on. Do those numbers make sense? Yeah, they absolutely match up. You're at 67% and change and 68%, something like that. Somewhere hovering right around that high 60s. That tells you kind of where you need to be. While the U.S. office market struggles, other types of commercial real estate have shown signs of green shoots. Things are happening. Little bit of growth there. A broad measure of property prices has climbed 3% so far this year through October, according to Green Street data, meaning things are going in the upward direction now. Maybe just by a little tiny bit, not a ton. But you're going to have to sort through all of this ridiculous stuff coming back to these lenders, because this one owner here has how many properties did they say they had? 7, and all but one have defaulted, and they got $2.2 billion in debt. So you got $400 million on the building we're talking about in play here. You got $2.2 billion with just this one owner, this one property owner, this one property manager. So with interest rates coming down, liquidity continues to return to the capital markets, said Brookfield corporate president, yada, yada, said during a November 14th earnings call. In the past few months, we've executed over $300 billion of financings across the business. So those are new owners coming in on properties that have gone back to the banks, and they're doing basically, new purchases, because that's the reset they need to reflect the lack of tenants that are out there for this type of real estate. You got to have a reset of those values, and that's what we're seeing. So is it helping these buildings that are already in default? No, not really. Those properties just got to go through the process, right? Notable highlights include our real estate business. The CMBS markets remain very active because you've got a market that is at the tail end or somewhere in that cycle of restructuring, probably trillions of dollars in debt. And 1 out of 10 is in default. And what does that go to? Probably more. It's crazy, right? But so declining values are a separate measure than occupancy rate, because occupancy rate now reflects tenant prices, dollars per square foot of rent, that have shifted dramatically because you just don't have as many tenants wanting the downtown core. Now that will change over time. I think that will, ramp up as more and more employers realize, we got to bring our people back in. Amazon's doing it, Microsoft's doing it, federal government's doing. We got to do it to appear, like we're, going down that road as well. But how long will that take, and how many will actually come back into these properties? That is the question of the hour, right? But all of this is kind of this massive reset in the commercial market. So to conclude, is a 69% decline in appraised value, does that actually transfer in this? Does it, recognize the actual market of what's going on? Yeah, I'd say somewhere between 67% and 70% decline in value is reality. That's a massive, massive reset. That means anybody that, moving forward wants to do something with their existing loan, you're going to go out and get an appraisal. What's that going to come back at? Oh, yeah, you're upside down by how many hundreds of millions? Yeah. And who's going to want to take on new debt, that nature? So all of that stuff is in play right now, and you're starting to see more and more of this, because it's like, okay, here's our data. This is the reset. These are the reset points. And you'll have this happen across the United States to some degrees, in some cities more, San Francisco, Portland, some cities less, Dallas, I think, believe it or not. And there's a handful of others that have done slightly better. New York City's been decimated, but even there, you've got some markets that are doing, better than others, depending on where they are kind of within the financial district. But a lot of this stuff, but most of across the board, you've seen a pretty significant drop in values in Los Angeles, which doesn't have a crazy big downtown financial core. And neither does San Francisco. And San Francisco has been absolutely decimated, closed. Metaleo. We talk about Metaleo doing those walk by videos of downtown San Francisco and in Oakland and anywhere around there. And that is kind of the epitome of, oh, yeah, that whole work from home thing is just emptied out these big commercial areas and the smaller businesses surrounding. So all of that impacts this 69% decline in appraised value. Yeah, that seems like it's a real thing. All right. Thanks so much for watching this video. I'll catch up with you on the next one. Bye for now.